Chapter 18, real estate taxes and other liens. Some of the stuff we're going to go over here, guys, it's already a review, just like in the previous chapter. There's a few things that's, you see how it starts getting familiar? We keep on repeating some stuff. In this chapter, we're going to talk about liens. You guys already know what a lien is. We're going to talk about encumbrances. You already know what an encumbrance is, but we're going to specify some types of liens. More specifically, we're going to go over real estate taxes. Now, real estate ownership is subject to duties imposed by state and municipal governments, typically in the form of taxes that become a lien against the property, right? To enforce payment of a debt or an obligation, a creditor or court may also file a claim against the property. The power to place a lien on the property provides governments, lenders, homeowner organizations, and anyone who offers work or services to improve the property with certainty that the property owner will satisfy financial responsibilities incurred because of property ownership. So as you guys know from previous chapters, we talked about encumbrances, liens, we talked about closings, how the closing happens. You know that we cannot close unless liens are satisfied, right? Or if the buyer says, hey, don't worry about it, I'll assume the lien or I'll take over the lien. That's a different story. So with that being said, anybody that places a lien against the property is pretty much sure that they're going to get paid. That's what it says here. There's a certainty that they're going to get paid. Why? Because at the sale, they got to pay it off, or because I have a lien, I can enforce it in court. So all encumbrances I wrote it wrong. Sorry. All liens are encumbrances, but not all encumbrances are liens. Okay, it's not, wrote it wrong. I have to correct this. Because a lien is an encumbrance, but there's different types of encumbrances, right? Not all encumbrances are liens. We have easements, we have encroachments, and all that stuff. Now, a lien is a charge or claim issued on the property of a person to enforce the collection of money owed. Whenever someone borrows money, the lender will typically request a collateral. The security, also known as collateral, is something of value that the borrower agrees to surrender to the lender if the borrower defaults on the debt. When the lender's security is real property, the security interest is referred to as a mortgage lien. We already know this, right? Familiar now? Some of the stuff? Liens are not limited to serving as a collateral for borrowed funds. A government entity, for instance, may place a lien on the property for unpaid property taxes owing by the owner. A lien may also be used to compel payment of a tax or other specific obligation. So it's not always debt, money that we borrowed, right? A lien represents an interest in an ownership, but it's not the same as actual ownership. You guys remember this as well? Equitable title, interest, estates, all that stuff. It's all from the first week. I know it's tough to remember the first week, but right? It says that a lien represents an interest. I can have a lien against your property, but that does not mean I'm the owner. But I have an equitable or valuable interest or title. Does that make sense? Right? So it is an encumbrance against the owner's title. A charge or claim that attaches to real property and reduces its value or impairs its use, it's an encumbrance. And liens are distinct from other encumbrances since they are financial or monetary in origin and are a result of a debt. Other encumbrances may be a physical type and impact the owner's use of land, such as easements and encroachments. So repeating like a summary of what we learned in the first week. According to state law, if a lien is not paid within a stipulated time, the lien holder may foreclose on the lien, potentially forcing the sale of the property. Depending on how the lien was generated, the lien holder may be required to begin legal action to enforce the property sale or gain title. In other instances, the property may be sold without a court hearing. You guys remember the difference between these two? One where we got to go to court and one where we don't have to go to court. Anybody remembers these? If we have to go to court, that means the property is in a it's a foreclosure. That's the process. But what type of state are we in? If we have to go to court, probate is when somebody dies. We're in the lien theory state, thank you, Shakira, and therefore it's a judicial case. When we go to court, court is judicial, okay? If we're in the state where we bypass sold without a court hearing, it means it's a what type of theory state? One is a lien theory. If there's a lien, we got to go to court. The other one is I'll help you guys out. Title theory. It's not in this chapter. It's not written down, so it's not going to help you. We have lien theory states, right, where the property is under your name, but the lender puts a lien against the property. And then there's title theory states where the title goes to a third party while you're paying off the loan. You guys remember this? Say yes in the chat if you remember, say no if you don't, and say somewhat if you kind of remember. Connie, yes in the chat. Somewhat. Okay, cool. All right. So lien theory, title theory, that's the difference between these two. The debt is paid from the sales revenues and any remain is returned to the debtor. All right, different types of liens. There's two ways to classify liens. One way is based on how they were created. One of them is obviously being voluntary. And if one way is being voluntary, then the other one is involuntary, right? What is voluntary? What's something that's voluntary? If it says voluntary, what does it mean? When you have a choice, right? Did anybody force you to be here today? No, you chose to be here, right? So it's voluntary. You asked for it. So a voluntary lien is created intentionally by the activity of the property owner, such as when obtaining a mortgage loan. We asked for the mortgage loan, so we asked for that lien. It was a voluntary lien, okay? Involuntary means what? Forced. Involuntary means it was forced. You did not ask for it. It was imposed on you, right? So the imposition of an involuntary lien, not always court ordered, but we're going to get there. An involuntary lien is mandated by law and may be either statutory or equitable. For example, a real estate tax lien is an involuntary statutory lien. It exists without the property owner's intervention. So you're telling me, Masha, that real estate taxes are a lien that's court ordered? They're not. It's a statutory lien because state statutes allow, or state rules allow, the state, the county, and the municipality to impose that lien on you. Okay? Then there's the equitable lien. And this emerges out of common law when the judgment, now we're talking about court, requiring a debtor to pay the balance on a delinquent charge account is filed in the county where the debtor owns the property. So that one's a court order. So statutory rules of the state allow this lien, equitable court ordered lien. Now the other liens can be categorized, the other category of liens, based on the type of property involved. Now, we have general liens and we have specific liens. Okay. If we have general liens and we have specific liens, that means that general liens involve more than one property, right? It's general. Specific liens involve one property. So general liens impact all of the debtor's property, all of it. And this includes real and personal property. This includes real and personal property. So if I don't pay any of these liens, which I'm going to go over in a second, right? When they enforce the judgment, they come after any real estate that I have, any car that I have, any checking account, savings account, IRA, 401k, tax returns, your driver's license, your passport. By depending on the type of lien, they can go after everything and stop you even from breathing almost, right? Financially breathing, I mean. So these are called general liens because they affect everything you own. Included in this category are judgments, so general judgments, estate and inheritance taxes, decedent's debt, so when there's probate, company franchise taxes, and of course, internal revenue taxes. Did we do a calculation, Nasha? Nasha, we're calculating something. I got minus 960. What happened here? Did you lose $960, Nasha? What happened? Don't tell me I owe you money because I don't. This is when we catch them on the wrong chat. You see? You see what happens? It was the wrong chat. There's no way for you to do minus 960 if you're in this chat. It's very specific. The numbers are so far apart. There's no way. Your phone fell on the keyboard and he went like back, like really far away from every single spot of that keyboard. Yeah, I've seen those TikToks too. Where wasn't me. All right, got it. So there's also child support. I didn't put it here, but there's a whole child support goes after everything you got. Now, a real estate lien is distinct from a personal property lien. A lien attaches to real property as soon as it's filed and recorded. In contrast to a lien on personal property, does not attach until the personal property is taken. So if it's a real property a lien, as soon as it's filed and recorded, it's attached to the property. Personal property is whenever they take it. So if they repo your car, immediately starts the lien. Okay. Specific liens. These are secured by specified property and solely affect that property. Specific liens affect that one property only. Okay. Specific liens on real estate include vendors liens, mechanics liens, mortgage liens, real estate tax liens, and liens for special assessments and utilities. A vendor's lien is a lien belonging to the vendor or seller for the unpaid purchase of the property. When the vendor has not taken any other lien or security, such as mortgage, in addition to the purchaser's personal duty. Vendor liens on real estate are rare and result from the use of owner financing to sell the property. We talked about these as well when we said installment sales contracts, contract for deeds. I don't know if you remember this stuff. When we talk about lease options, I told you one was similar to car lease, the other one was similar to car finance. If it's a car financing style, it's called a vendor's lien. All right, what's the effect of the lien on the ownership? Well, a lien holds you down, right? It doesn't stop you from selling, but it holds you down. The values change, right? So the existence of a lien, if you guys remember, does not necessarily prevent the owner from transferring the ownership to another party, but there's very few purchasers that will be willing to assume the risk of purchasing a property with a lien on it, hence decreasing the property value. So I will buy it from you with the existing lien, but I won't pay market value because I have to deal with the lien, right? Since the lien attaches to the property and not to the owner, a new owner could lose the property if the creditors pursue legal action to compel payment. You guys remember that too when we talk about buying subject to the mortgage or assuming the mortgage? You guys remember that? Let me know in the chat if you remember buying subject to or assuming a mortgage. You don't have to fool me. It's okay to say no. I don't remember. Okay, I got a few yeses. All right. Once established, a lien runs with the land and binds all subsequent owners until the lien is paid and settled and title is cleared through the filing of a release of the lien by the lien holder. So I can sell it to you, you can sell it to the next person, to the next person, to the next person. If the lien was not satisfied, it stays against the property. This is why when we go to a closing table, we try to pay off the liens. I'm sure you guys remember priority of liens. Who gets paid first? Without reading, who gets paid first in the event of foreclosure? Katie for the win. Sorry, Alex. She was faster than you. Masha, sorry, too slow. Katie won. Taxes always get paid first. They're the superior lien. What about the rest of the liens? How did they get paid? How do the other liens get paid? What is their priority? It depends on priority, but how do we determine priority? Taxes are superior liens, so we know. How do we determine the priority? In the order of records, Milton? Give me a little bit more. In the order that it was recorded. That's what you're saying, Milton? Lacey? Yep. When it was recorded. So here's what you guys got to remember. Taxes, property taxes are always first. Property taxes are always first. After property taxes is based on when it was recorded. So first in time, first in line. You guys remember, I mentioned that, right? So the priority liens refers to the order in which the property claims will be satisfied if the debtor sells the property. According to state law, the priority of payment is normally determined by the date that the liens are recorded. If the holder of the first lien to be recorded forecloses on that lien, the profits of the property sale are used to satisfy that lien. Pay attention. If any funds remain, so if there's any money left after paying the first lien, if there's any money left, the holder of any debt is paid, any other debt. So if there's a second lien, they get paid. If there's a third lien, they get paid, as long as there's enough money. In a foreclosure, there might not be enough money. So what happens to these junior liens? They might lose money. They might not get paid at all, right? So the holder of a junior lien, one that comes after an earlier claim, may foreclose, but the property remains subject to the lien or liens having greater priority. So a second lien can start a foreclosure, but you're second. So if you started a foreclosure and there's not enough money, sucks for you, you know? So it is very important for a creditor to have the highest lien priority, because it will mean that the creditor will be paid first if it becomes necessary to bring about a forced sale of the debtor's property. A creditor in the second or later position may receive little or nothing from the sale. There are exceptions to this generalization. So I already said real estate taxes take priority. And then we have subordination agreements. Without reading, do you guys remember subordination agreements? Who can tell me what this is? What is a subordination agreement? What does it mean? What is a subordination agreement? You say it's a clause. Any agreement will have clauses. But what does it mean? Subordinate. What does it mean to be subordinate? When you're subordinate, you're underneath. Okay. A subordination agreement under someone's powers. Okay. So we have first lien, we have second lien. Second lien is subordinate to the first, right? A subordination agreement, Shakira, thank you, is when a junior lien can take over the priority. You guys remember that? A junior lien, so a second mortgage, like a construction lien, can say, hey, I will give you the money to improve the property as long as I have priority. Now, we cannot change public records as far as dates when it was recorded, but we can file a subordination agreement that says, I know that the first mortgage is first, and I know that second mortgage is second, but we agree to switch priority in the event of foreclosure. That's what a subordination agreement does. Okay, it allows the second mortgage to be first, even though they were recorded at a later time. All right, this chapter is about taxes. Guys, cameras on, please. Oh my God, always a fight. Seriously. Did not give you enough of a break? It was like 15 minutes or so. All right. Real estate tax liens. So there's general taxes and there are special assessments or improvement taxes. Okay. Now, these are the two types of taxes. Both are assessed against a specific real estate parcels and are consequently made liens against those properties. Real estate taxation refers to the imposition of property taxes on real estate at the county and municipal levels of government. Taxing entities or taxing districts levy real estate property taxes. There are no federal taxes. I'm sorry, there's no federal real estate taxes. There are no federal real estate taxes. The United States Constitution expressly outlaws such taxes. However, the federal government taxes income produced from real estate and gains realized from the sale of real estate. So on the ongoing maintenance of real estate, there's no taxes. If you sell it and you make money, they impose income taxes, right? Federal government can place a tax lien on the property for failing to pay the IRS. And then states. States may impose taxes on real property, but most of them, they delegate this authority to counties, municipalities, and other local taxation units. Some states impose restrictions on how local governments may impose these levies. States may place a tax lien on property for failing to pay any state levied or delegated real property taxes to local taxing entities. Okay, and county and local governments. To obtain cash for providing local services, counties, cities, and municipalities, townships, and special tax districts levy taxes on real property. Commonly, the county collects all real estate taxes and distributes them to other taxing entities. Now, when you see the word district, what do you guys think? What do you think district is? It's a zone, it's a section, it's a county, it's an area. That's what we usually think, right? And so tax districts are taxing bodies, entities. It has nothing to do with the area, okay? In fact, these are some of the taxing districts. States, counties, cities, right? Of course, areas like you were saying. But then we have drainage districts, hospital districts, school districts, water districts, sanitary districts, transportation districts, parks, forest preserves, special tax and improvement districts. So for taxation purpose, districts are taxing bodies, meaning what we pay taxes for. There's more than these, but These are the general things we pay taxes for. We pay for sewer, so drainage, sewer and water. We pay for hospitals, public schools. We pay for transportation. We pay for the parks in the city, right? So we pay for all this stuff. These are tax districts. And these are paid based on two things. Like I said before, is the general taxes and based on the special assessments. Now, let's start with ad valorem. Ad valorem means according to value. For those of you that don't speak Latin, I don't either, but that's what it means. Ad valorem means according to value. This is also the same as general taxes. So when we pay taxes, like say $12,000 a year on taxes, okay, what we're paying is the general taxes. And we're paying those taxes according to the value of our property. Now, one of the things that a lot of people have wrong is that they think it's the value, market value. No, the ad valorem, according to value, it's a general property taxes that's based on assessed value for taxation purposes only. So ad valorem is based on assessed value for taxation purposes only. In fact, anybody a property owner here? Do you own the property? Let me know in the chat if you do. Raise your hand. There you go. All right. Are you a property owner, Alexis? Okay. So have you ever looked at your tax bill? I'm sure you have, right? And when you looked at your tax bill and you saw the value that they put there, right? Does that represent the value of your property if you were to sell? Like when you look at it, is it more? Is it less? Is it the same if you were to sell? Let me know. Steven says no. Amir says no. Steven says less. So roughly 17 years ago, my first property, I bought two properties at the time, at the same time. Things were easy back then, I'm telling you. So I bought two properties at the same time. Not that I had the money. Things were easy back then. To get loans was easy. I could have bought 10 properties if I wanted to. As long as I had the down payments for a few of them, I could have. Anyway, what was I saying? So I got scared because I bought a property for $300 and something thousand. And I tell this story in every class. So if you've heard this, I'm sorry. But I paid $340 for one, $360 for the other one, I think. And a couple of months later, I receive a tax notice, not a tax bill because the bill is included with the mortgage, but a tax notice. So it's like almost like it's a bill, but it's a notification. Don't pay this, it's just a notification, right? And all of a sudden it says land value, building value, and total assessed value. I look at it, it's $100 and something thousand. I'm like, no, hold on, no. I just bought this property for $300 plus $1,000. And it says here it's worth 100 and something. You guys don't understand. It was my first investment. I had a lot of headaches for that investment. I had a bad tenant. I think I mentioned in the previous class, really bad tenant, stayed there for a whole year, 9 months almost without paying. And here I am looking at a tax bill that says that my property is, I didn't know anything about real estate back then. My property is worth 120,000. I almost started crying. I swear to God, like my first investment, 2 properties, and I got robbed. These realtors, I got robbed, right? So immediately immediately, well, next day, I called the city to figure out what is this? I just bought a property. I have a complaint. I don't know what to do. I just bought an overpriced property, $300,000. You guys tell me that this is worth only 100. Oh, no, sir. That is the assessed value. I'm like, yes, the value, right? Also, I've been here for 21 years now. So I was very recent in the United States. So assessed value, like I saw value. That's what I'm thinking, right? So she says, no, sir. That's for tax purposes. That's a value that we attribute for taxes. You should be happy that that number is lower, because the higher the number is, the more you pay in taxes. You don't understand the relief that I got at that moment. Okay? All right? You guys know when I'm sure everybody knows, you're all adults. You guys know when you're really tight, you need to go to the bathroom, and it's like takes hours before you get there. And then you actually release and you're like, oh, I'm in heaven. I swear to God, it was almost the same feeling. I was panicking, and all of a sudden I'm like, relaxed. Cool. I found out that way. Sorry about the whole bathroom, right? But I found out that way that there's two values that are separate, one for tax purposes and one for market purposes. If I were to sell my property at the time, I could actually make money. I could make immediately 20K. It was worth more at the time that I received that bill, which was a couple of months after I purchased the property. I could have sold the property for $20,000 more right there and then. Okay. But this is what I need you guys to understand, because you have to be able to explain that to your clients as well. Because when it's a first-time buyer, they do not know what assessed value is. You gotta let them know, hey, for tax purposes, you want this number to be as low as possible. So quarterly they send in February, and then every 3 months after that you receive bill notification. So I purchased in April, I think it was, and then in May or June or something, I received the notification. It says this is not a bill. I'm like, already relief right there. But then I see the amount, I'm like, oh. All right. So you got to be able to explain this stuff. Okay. Though based on the assessed value, the actual annual tax can be calculated as legislative percentage of the assessed value. The land and improvements can be valued separately. Is all right? I'm going to put you on the spot for a second. Is that okay? Just say yes or no in the chat. I can barely see you, so I'm just say yes or no in the chat if you can. Yes. Okay, cool. So guys, I want you to search Zoraida real quick over there. Can you guys search her? Now that's commitment. I hope you feel better, by the way, Zoraida, and let me know if you need anything. But for those of you that are constantly away from the camera, those of you that are constantly doing everything else but paying attention, that's commitment. Zoraida is right now in the hospital bed, and she's doing the class. Now that's commitment. Okay? So not putting anybody to shame, but I'm just saying, she's not walking around distracted. The moments that she, by the way, the moments that she had to leave the bed or go to a different room or whatever, every single time she sent me a message, say, Bruno, I'll be right back. They're moving me to a different room. Okay? That's commitment. So I'm not saying that Zoraida is going to pass or fail. What I'm saying is she's trying, honestly trying. And I know some of you are as well. This is for all of you that are taking this as, I just have to listen to Bruno and I got it. All right. I don't even need to pay attention, participate, or anything. I can walk around. I can be with my friends. I can do whatever. All right. So, Zoraida, for that, please, anything you need, reach out to me. I know it's been tough for me to reply to a few people. I did communicate with you not too long ago, but anything you need, even though I might take a few hours or days to reply, Just make sure you keep reaching out. Okay. All right, cool. What am I going to say to the next class? I'm like, you guys got no excuses. I had a student in a hospital bed taking this class, and you guys are here. Oh, it's Friday night. I have to go out, or I have dinner with these people, or I have vacation, or whatever. Please. Yeah. Anyway, general tax exemptions. Because yes, what does this word mean? Loopholes, right? We said that before, didn't we? Loopholes. So how can we avoid paying taxes or reduce taxation? Most state laws exempt certain real estate from taxation. Such property must be used for tax-exempt purposes as defined by statutes. The most common exempt properties are owned by, obviously, municipal. So if it's a city, they don't pay taxes. If it's a state and federal government, they don't pay taxes. Hospitals might not pay taxes. Educational institutions, so schools might not pay taxes. Various municipal organizations, schools, parks, playgrounds, and religious and charitable organizations on the private side. Okay. Stephen says, my church and my house. There you go. What if you are homeschooling? Oh, you want to make your house that's it. Guys, for about a month, you don't pay taxes for this month, okay? Just let them know that you've been in school at home. Maybe if it's a legit homeschooling, if you can prove that that's what's happening, you're not enrolled in any school or anything like that, you might be able to get some type of credit, but that goes from state to state. There's a lot of more exemptions. These are the most common, by the way. So there's a lot of more exemptions. Depending on the type of, we're going to go over some, and when we get to the state portion as well. Like here, it doesn't talk about farmland. Farmland has also exemptions or reductions, but that goes from state to state. All right. So many state laws allow special exemptions from real estate taxes for specific property owners or land uses. Senior citizens, veterans, people with disabilities, for example, are frequently granted reductions in the assessed values of their homes. You guys are going to love it when you get to the Jersey portion, because the deduction or reduction is $250. If you know the taxes in Jersey, right? $250 is a joke. Yeah. Anyway, now in some states, low-income seniors can request a property tax freeze on their primary residence, which means that the tax assessed will not increase during the senior's ownership and use of the property for the remaining years. The problem with that, and I'll mention it when we get to Jersey as well, the problem with that is every single year you have to apply for this exemption. So every single year you have to remind them that you're still a senior citizen. It's the craziest thing. It's not like, hey, I reached 65. Please don't tax me anymore, or tax increases. No, every single year you have to say, I'm still over 65. And if you don't do it, it's not retroactive. It's not like you can call and say, hey, true story. I had a student of mine tell me that her 82-year-old mother or 83-year-old mother found that out like 2 or 3 years ago, or before her current age, right? And goes like, I found out that it wasn't retroactive. So my mom could have claimed this since she was 65. She started claiming it when she was like 79. So all these years go by and you cannot claim it. Isn't that crazy? Crazy. All right. Connie says, my town does that, but if you have a school-age child in the home, they charge the tax. So, no. So my mom could get the freeze, but my sister and her kids moved in, so they, oh, yeah. Okay, gotcha. Now I got it. Yeah. So, but it's not just because of that, it's also the household income changes. That's pretty much what it is. So she also contributes to the household income. This is based on low-income seniors. If you're there, you're a contributor one way or another. Okay. All right. To help fight recent record number of home foreclosures, some states have subsidized low-income homeowners' tax bills regardless of age. To attract industries, sports franchises, and new developments, some state and local governments, they offer real estate tax breaks. Many states also provide tax breaks for agricultural land, like Jersey does. All right, assessment. What does it mean to assess something? It's to evaluate, right? So assessment. County and township assessors or appraisers value real estate for tax purposes. This official valuation procedure is known as assessment, and although the practices vary, the assessed value of a property is generally based on the sales price of comparable properties. Land values can be evaluated independently of the building or other improvements, and different valuation methods can be used for different types of property. Property may be reassessed on a regular basis under state law. So, in a lot of municipalities, especially those that don't have much movement, they have defined, so it's not just the state law, it actually goes to municipal law as well. Some municipalities have defined reassessments every X amount of years. Some every 5 years, some every 20 years. It all depends on mainly the turnover of properties in the area. Because the more sales we have, the easier it is to figure out their sales price and therefore their values. Okay. Okay, Emily. And therefore their values. If there's not enough sales, then how can we figure out the evolution of the value or the attraction of the value? So progression or regression, let's say, if there's no sales. So that's why they assess it on a regular basis. Now, a property owner may believe that an error was made in determining the assessed property value. Usually that assessment is too high in comparison to the neighborhood property's assessments. Property owners may raise their concerns with the local board of appeals or board of review and can even take that appeal to court if they want. So if you're not happy with your taxes, what can you do? Cry about it. That's what appealing is, right? Isn't that what the babies do when they're hungry? They cry. They're appealing to mom or dad, say, feed me, please. In this case, it's the same thing. You go in front of the board and say, hey, help me out. If you don't, they will not feed you. They will not lower the taxes because property value is lowered. They will lower the taxes because you cried about it. Okay. All right. We'll talk more about that when we get to the state portion because we'll go through the state procedures on how to appeal. Equalization. What is equalization? As the name says, making everything equal or fair in this case. Some taxing bodies recognize that local assessments can lead to unfairly high or low values for properties in certain areas. Therefore, the jurisdiction may establish equalization factors to level out the unevenness of valuations. For instance, if assessed values of properties in one county are consistently 10% below the average for other counties, an equalization board may multiply each assessed value in that county by a factor of 110% to raise them to the average level of the state. So we're offsetting. You guys remember when we talked about in appraisals, if there's a difference between properties, we offset the values to figure out the value of ours? This is something similar. So if a county or municipality has more needs than another, right? The state has a budget to fund, because the state is the one that funds all the counties for education purposes, for instance, right? So they have enough money, education for any other purpose that will run the county, right? So they say, hey, this county needs more help than this county does. So we're going to adjust. And that's where this 110% comes in. All right, and I'll show you what you need to remember is how to do the math. I'm going to show you in a second anyway. All right, tax rates. Did you guys know, I'm going to show you to you in a second. Did you guys know that you pay exactly the same taxes as the person next to you? Regardless, you pay exactly the same taxes. Is that true or no? You're trying to read? No, it's not there. What I'm trying to say is not there. Yeah. We pay the same taxes. Yeah. I'm going to tell you how the taxes are determined. The tax values are determined. Now, your tax bill might be the same, might be different, but the tax is the same. You're taxed at the same rate. The reason why your tax bill is different is because of different assessment values. But your tax is the same. If I pay 3% tax, you pay 3% tax. If I pay 10% tax, you pay 10% tax. That does not change. That's the taxation. The bill is based on value. Okay, so think about it the same way as if you go buy something, the taxes are 6.625. It's everyone, unless you're in an urban enterprise zone where it's cheaper, but across the board, usually, if there's no exemptions, 6.625 right now, right? That means that every bill you pay comes with 6.625 taxes added onto it, right? Now, I might spend more money than you do, but I got taxed the same. Does that make sense, what I'm trying to say here? All right, so, but how are we taxed the same? What is the reason of being taxed the same? So right here, the process of determining the real estate tax begins with each taxing district adopting a budget. So you guys remember the taxing districts? The school, the city, the parks, the hospitals, right? All of them figure out how much money they need, budget, how much money they need to run the next year. So we're projecting next year's budget. What we're going to do is put it all together, right? It's called appropriation. We're going to put it all together and we're going to tell the taxation board, hey, this is what we need. Taxation board now says, okay, well, the school needs 2 million. The hospital needs 5 million. The police department needs 1 million, whatever it might be, right? Put it all together. We're looking at all the districts. We're looking at $300 million. That's what we need. All right, cool. That's what we need to run the town next year. So the next step is appropriation, which means that the taxing body authorizes the expenditure of funds and specifies where the funds will come from. Appropriation is typically accomplished through the adoption of an ordinance or passage of law that specifies the specific terms of the proposed transaction. Any increase in real estate property tax in some states requires voter approval. The amount to be raised from the general real estate taxes imposed on owners through a tax levy. So the money that I need to run next year for all the districts, I will now divide amongst everybody in the municipality. Okay, we need $300 million. We're going to divide by the amount of the value of the properties we have. So each taxing body tax rate is set by state law or calculated separately. And unless the tax rate has already been determined by state law, the total funds required for the upcoming fiscal year are divided by the total assessments. The total assessments of all real estate located within the jurisdiction of the taxing body. So think about it this way. This property is worth 100K. This property is worth 300K. This property is worth 50K. This property is worth, I don't know, 70K. This property is worth 90K, and so on. What we're gonna do is we're gonna add these. Let's say these are the 5 properties in New Direction Municipality right now. We're gonna add these, and whatever this value is, it's the total assessment value of all taxable properties. So we don't count, obviously, we don't count for City Hall, we don't count for public libraries. Anything public does not account for because they're exempt. You already know that. So we add whatever this is value. Let's say the value here is 10 million of all the properties. It's 10 million. And we know that we need to raise what? I said 300 million, but let's say 300,000 to make it simple. This is needed to cover the budget. So we're going to divide these, and that will be 0.03. So I'm sorry, 0.03 or 3%. So this is the tax rate right here. See, we didn't look at each individual property. We look at the total value of all the properties. We divided the money we needed by all the properties, and it gave us a tax rate. What we do next is apply the tax rate to your individual unit. So here we will be times 3%, times 3%, times 3%, times 3%, times 3%, and so on. So if your property is worth 100K, your bill is $3,000. Simple as that. Does that make sense, guys? Any questions on this? The tax bill, the tax is exactly the same. Your bill is different based on property values. The tax is 3% across the board in this instance, okay? To cover, what are taxes for? To cover the budget for next year, okay? And it's the same across the board. Every single property in the municipality pays the same. Now, in Elizabeth, the taxes might be different than Newark. Newark might be different than Linden. Linden might be different than Mawa, and so on. Every municipality, okay? All right, there are several ways to express the tax rate. Several ways to express the tax rate. In many places, it is expressed in mils, which is 1/1000 of a dollar, or 0.001. And the tax rate can be expressed in mil per dollar terms, such as dollars per hundred or dollars per thousand. In New Jersey, it's dollars per hundred, but we'll get there when we get there. So the tax rate of 3.2%, for instance, is equivalent to 32 mils, or $3.20 per every $100 of assessed value, or $32 per every sorry, is mils. It's a mistake here. 0.032 mils, or $32 per $1,000 of assessed value. Now, the easiest way to know this is if you guys see right here, 0.001. So if 1 mil is 0.001, then 0.032 is 32 mils. Okay? 32 mils. And if it's based on 1,000, right? Another way to look at it is if it's, so that's why I said 32 mils, right? If it's based on 1,000, that means this is 100. If this is 100, I'll show you again in math, but it's just to give an idea. If this is 100, then, sorry, Based on 1,000, but this is 100, right? So if this is 100, then this represents 3, and that's a 2. So it's 3.2%. Okay. Just a few ways to get to it. All right, calculations. We got the tax bill. I already explained to you how we do this. We figure out the tax rate, 3%. The property value is 160. Therefore, the annual taxes are, in this scenario, 4,800. The question could be exactly what it says here. Property value is set at $160,000 with a property tax of 3% or 30 mils. What would be the annual tax bill? All you had to do, value times rate, and he gives you the tax bill, 4,800 a year. Now, if they say there's 100, let's say the same question says there's 120% equalization factor, right? Then you have to do the first step that we just did. I'm sorry, the first step, which is apply the equalization factor. And the equalized value is 192. Okay. Then step number 2, you apply the tax rate. That means that your annual bill is 5,760. So what just happened? Our property is in an area that needs to be equalized to be fair to other areas, right? So they increase our taxes based on the needs of the area. We talked about this in equalization earlier, right? The question, if anything, is going to be a math question. They're not going to ask you what is equalization for. It's going to be a math question. So here's what you have to do. Apply the equalization rate, apply the tax rate, answer the question, and move on to the next one. That's all you got to do. They're going to give you all the numbers. You don't have to figure it out. Apply the equalization rate, 120%. From that result, apply the tax rate. That's the answer, and move forward. You got it? Cannot get any simpler than this. It's a math question. If it shows up, it's a math question. That's all you got to do. Questions? Anybody got questions or no? Who's lost? Let me know in the chat that you're lost. And I'll go back to chapter 1 right now. All right. Payment deadlines. Like any bill, we have what's called a due date, right? With any bill, we have a due date. What happens if you don't pay by the due date? You get penalized, of course. How do you get penalized? They can sell your taxes. And if they sell your taxes and somebody buys, that person now has equitable title to your property. And if you don't pay them back, I'm going to show you all this in a second. If you don't pay them back, they can foreclose on your property because they paid the taxes for you at auction. All right. So payment deadlines are usually set by law and differ from region to region. We'll talk about it when we get to the New Jersey portion. Different taxing bodies may have different fiscal years, and as a result, may issue tax bills at different times of the year. It is more common for a county to issue a bill that consolidates the bills of all the lesser taxing bodies, and the consolidated bill may be payable annually, semi-annually, quarterly, or some other schedule as prescribed by law. In many cases, where the owner has a mortgage and a required escrow account, the escrow officer will pay the tax bill. So like I told you, when you pay a mortgage, usually the mortgage company takes care, or the lender takes care of paying the tax bill. You guys remember the PD payments? PITI? PD payments? What does it mean? PD payments. PITI. Say louder. Well, one thing you said right.
Interest.
The interest you said right. What is PITI? PD payments. Yes. All right, Masha for the win. Principal. You missed an E over there. Principal, interest, taxes, and insurance. Okay, so most loans are PD loans. They include all of it. Some loans are just principal and interest, and you handle your own taxes, your own insurance. Okay. So the owner will only receive a notice, like I told you before the story, of the assessed value and a tax statement. To encourage prompt payment of real property taxes, some states offer discounts and monthly payment plans. Penalties are added to all the taxes that are not paid when due, typically in the form of monthly interest charges on overdue taxes. How do they enforce these tax liens? The real estate taxes must be valid to be enforced, of course. That is, that they must be properly charged, used for a legal purpose, and applied equitably to all property. Tax liens, as previously stated, usually takes precedence over all other liens against the property, and real estate taxes that have remained unpaid for the statute of limitations can be collected through a tax sale of the property. While the methods and details of each state's tax sale procedures vary significantly, the results are the same. After a court has rendered judgments for overdue taxes, penalties, and administrative costs and ordered that the property be sold, a tax sale is usually held in accordance with published notice. So, who wants to buy somebody else's taxes? Nobody, right? You don't even want to pay your own taxes. Why would you buy somebody else's taxes? See, like I said earlier, it gives you equitable interest in the property. Okay, it's different than paying my PSE&G bill, where you get nothing out of it. Does that make sense? And paying somebody's taxes before an auction also doesn't give you any rights to anything. This is at auction only. A notice of the sale is posted on the affected property, and the sale is advertised in local newspapers. The property is then auctioned off in a public by county sheriff or other public official, and whoever buys at a tax sale must pay at least the amount, that amount, because of a specific amount of delinquent tax and penalty must be collected. When the highest bidder pays a delinquent tax amount in cash, the highest bidder is usually given a certificate of sale, and the holder of this certificate has the right to take possession of the property, but not right away. Okay, so state statutes tell you when. The holder of the certificate, in class with me, not talking. Alex, you're fired. Shane. Tell whoever it is every 5 minutes coming around is not good. We're almost done. All right. Redemption after the tax sale. In this case, the defaulted owner or defaulted owner's creditors may redeem the property by paying the tax sale proceeds plus interest and charges, including any taxes levied from the sale. This is known as statutory redemption right, and if the property is not redeemed within the prescribed time frame, the certificate holder may apply for a tax deed or sheriff's deed, and the quality of the title conveyed by a tax deed differs by state. Now, before anything else, here's what just happened. I purchased your taxes at auction. I cannot do anything until the redemption period runs out. It's different from state to state. Okay, here in Jersey it's 2 years. I got to wait 2 years before I can foreclose on you. So that means that you owe me taxes and interest every year until you pay it off. Okay, so let's say I paid $15,000 worth of taxes for you, okay, at the auction. State of New Jersey statutory interest is 18%. Okay, but you cannot touch that money for 2 years. You want a better savings account than what you have? This is what you do. If you got $15,000 in a savings account, take it out, invest in tax certificates. Let it be for 2 years. You make 18% on your money. 18. Show me a bank that gives you 18% on a savings account. The reason why I'm addressing savings account, because the name says it all. It's savings. It's supposed to be set aside, right? Right? Here's the same thing. It's set aside for 2 years. You cannot touch it unless they pay it back. It's a win-win-win situation. If the homeowner does not pay the taxes, the bank will. So win-win. If neither one of these wins paid the taxes, you foreclose on the property. So you get the property for $15,000. Plus attorney fees and all that stuff. If I've done it, yes. I do have to say something about this. I have done it, but I don't do on properties that are occupied. I wouldn't want that to happen to me, so I wouldn't do it to anybody else. I see a lot of horror stories where people don't pay taxes, and here comes the corporation that purchased the taxes and just kicks you out. Like, that could be you in a few years. You never know what's going to happen tomorrow. So if you are to do something like this, make sure, if you're going to go through with foreclosures and all that stuff, make sure it's a property that's vacant. Okay? Bad karma, yes. In some states, delinquent taxpayers has the option to redeem the property at any time prior to the tax sale, and the equitable right of redemption is exercised by the taxpayer by paying the delinquent taxes plus interest and charges, including any court costs or attorney fees. And an owner who fails to exercise his rights may be forced to sell. All right. Special assessments. This is the last thing. Special assessments. Special assessments are also called improvement taxes. Special assessments are also called improvement taxes. But these are public improvement taxes. We're not talking about the taxes, I mean the improvements you do in your basement, in your backyard. That's not what we're talking about. We're talking about improvements to the roads, improvements to the infrastructure. Okay, but these are capital improvements. So some of these examples are sidewalks, water service and sewers, and special assessments are based on the cost of the improvements and apportioned on a prorated basis among benefiting properties, according to the value that each parcel will receive from the improvements. For example, a dredging project is approved to deepen the canals for a canal front subdivision. The project cost is $200,000. This is a capital cost. It's not like a regular maintenance cost to run the municipality, like the education board or board of education, the taxation board, and so on. This is a capital cost. So, although there are 100 properties in the subdivision, only 50 of those properties are directly on the canal and stand to benefit. Therefore, assuming each canal front lot receives equal benefits, the 50 properties are each assessed $4,000 as a special assessment. So this special assessment or improvement tax is only taxed based on the benefits that you receive. So if they fix the road right in front of you, as an example, they make it brand new, going right in front of your house, you have a direct benefit of it, right? Or from it. The person that's your neighbor behind you, are they going to benefit from what happened just in front of your house? No, they don't have a direct benefit. So they don't get charged for the special assessments if they have a route out of there. Now, if their route is around and they have to go in front of your house to get to another road or get out of the area, then they might be charged a little bit of that cost. Does that make sense? Okay. All right. If the taxing entity initiates an assessment, the assessment creates an involuntary tax lien. And if the property owners initiate the assessment by requesting the local government to provide the improvement, the assessment creates a voluntary tax lien. Special assessments are usually paid in installments over a number of years. However, taxpayers generally have the option of paying the bill in a lump sum or otherwise accelerating the payment. So even though it's $4,000, you can spread it over 5, 10 years, whatever. All right. We're done. These other types of liens, real quick. Mortgage lien, you guys know what it is. Mechanics lien, we talked about it already. You guys know what a judgment is. It's a court order. Okay, list pendants, we already said it plenty of times when the lawsuit is pending. Estate and inheritance tax, as it says, if somebody died and you owe taxes, they come after whatever property was there. Lien for municipal utilities, if you don't pay your water bill, they'll come after it, and so on. So franchise tax lien and IRS tax liens, these are general liens that might affect your property.